Well, stocks have had a great quarter so far. The Dow's up nearly 11%. In any year, that would be a good return. But our market guest tonight says there may not be much more upside from here. He's Stephen Wood, Chief Investment Strategist, Russell Investments. Mr. Wood, welcome. Good to have you with us.
Nice to see you again. How are you?
I'm great, thank you. You have a year-end target on the S&P 500 of 1550. That's actually 5 points or so lower than it is today. Where do you see the trouble coming from? Or have we just made all of our year's gains in the first 10 weeks?
I don't think that is a troublesome number. We have had a very good year, as you mentioned, very robust. You know, markets tend to have very choppy, very volatile patterns of returns. Some years, you know, you'll get a run up and a pullback, then a run up like we had last year. This year, we've had a very good first quarter. But even if we just hit the books and close them right now, it'll still be a good year. We think it's going to be volatile between now and the end of the year, but our numbers are based upon fundamentals, and the fundamentals haven't changed a lot. Sentiment, however, has. So we're seeing investors become more confident in equities. But that said, we do like equity markets, globally diversified multi-asset portfolios. Our clients are going to have to extend out that time horizon and hit a portfolio that really meets that goal that they're trying to accomplish over the next
I didn't hear you mention the word Cyprus once in that first paragraph or two of your thinking. Do you think that the worries over Cyprus are overblown or not?
Well, Cyprus as a specific entity, it's going to be overblown. I mean, it's very small. It's 0.2% of the EU. You know, forget the global markets, just of the EU. So it's very small. Cyprus has the potential to represent contagion. So if Cyprus, like Greece before, and it's much smaller than Greece, by the way, if that were to infect, let's say, Spain or even Italy, then it would become an issue. If it doesn't, it becomes very localized. I think the big issue in Cyprus that's very troublesome is they have their version of the FDIC, which is deposit insurance, if you've got less than 100,000 euros. Now, that's rule of law. And if they were to break that for financing purposes, that would be very different. So Cyprus right now, when you compare that to what's happening in the U.S. housing, which is positive, which may be offsetting what's happening in terms of what Washington has taken away by the tax increases and sequestration, it's a very small episode in the scope of things.
So let me just probe a little deeper as to why you think the market will be flat through the end of the year. Do you think that the level of profit growth just will not justify any real further expansion of the price-earnings multiple, or what?
Well, I would say with the first part, yes. If you look at profits right now, they're very strong, and they have been for a while, but it is a maturing earnings cycle. And also, in this environment, you know, the U.S. economy is growing more like 2% and a lot less than like 4%. In that environment, you know, pricing is going to be challenged, you know, so the top line, sales, is not going to be universal for all firms. It's going to be balance sheet by balance sheet, case by case. So security selection becomes far more important. So I'm sorry, go ahead.
No, I was going to say, as you point out, the profit growth picture has been pretty good, but as you say, we're sort of getting at the mature point in that cycle, and I think the forecast for the first quarter is about 1 or 2% overall growth. But there are always ways that you can make more money than the index, or you can lose more money than the index tracking would lead you to believe. Where do you think the pockets of possible better than average profits would be between now and year end?
Sure. So we do like equities, and when you compare that to fixed income, which we find unattractive right now, certainly in government space, government bond space. So we do like equities. We like global equities. And again, it's going to have to be a multi-asset strategy, which is kind of all the above, looking at commodities, emerging markets, both debt and equities. Also looking in great companies in Europe, you know, north of the Alps probably. But there are good companies with strong balance sheets in Europe as well. Looking into Brazil, Russia, Indonesia, Malaysia. So stock by stock, just grinding it out. So the yards are available. We just think they're going to be tougher yards. It's not going to be so much a risk on, risk off. But if I can jump off an earlier point you had, which was fantastic, which is the expansion of the PE or the multiple. What we've seen is that the fundamentals have not changed a lot, and that allows us to be a little bit more, you know, flat from here until the end of the year. But sentiment is a very powerful thing. So if sentiment, if momentum picks up, if people become more confident and they like stocks, are willing to pay up for stocks, that could be rather strong. And we are looking at that right now. So if bonds are being sold to finance equities, that would change the dynamic, and we'd have to revisit our estimates for between now and the end of the year.
Stephen Wood, Chief Market Strategist, Russell Investments, thanks so much.
Thank you.